Hi, I'm Danny Michael, certified financial planner, registered life planner. And today, in today's webinar, we're going to talk about IRMAA. And IRMAA is a surcharge that is charged on Medicare premiums if your income's too high. And so we're going to talk about what it is, how it's calculated, um, and then ways to avoid it. Um, and so without further ado, let's go to the slides. So IRMAA is short for income-related monthly adjustment amount that can increase your Medicare Part B and Part D premiums. Um, put simply, what it is, it's a surcharge for Medicare beneficiaries that have to pay each month if they make too much money. So it applies to all Medicare beneficiaries. So if you're receiving Medicare, then it will apply to you, and whether you opt out for Medicare Advantage or Original Medicare. So point two here, Medicare uses the modified adjusted gross income that you report on your tax return from 2 years ago to determine if you're subject to IRMAA charges. And so, again, so looking at this year, 2023, 2023, if you're noticing that your Medicare premiums have increased, that's because your income from 2021 was too high. And so that's how IRMAA is calculated. It's looking back 2 years in the past. So in 2023, the standard Part B premium is $164.90. Those that are subject to IRMAA may see their Part B premiums increase by as much as $395.60 per month. And then the Medicare Part D premiums can increase by as much as $76.40 with IRMAA. So it's important to be aware of IRMAA brackets since this is a surcharge that can meaningfully increase your annual healthcare costs and or reduce your Social Security benefits. And so, especially if you're in retirement, you're on a fixed income, obviously you're watching all your expenses, this can be an unexpected extra expense that you can control and you can avoid. And so it's especially important, once you begin taking your RMDs or required minimum distributions from your IRAs and your 401ks, once you reach age 73, since it's more challenging to reduce your annual income, at that point. Fortunately, though, there's going to be a variety of strategies that you can leverage to reduce your taxable income, so you won't be subject to IRMAA. And I'm going to talk about some of those strategies throughout this presentation. So, first thing is how's IRMAA calculated? So, IRMAA is calculated by the IRS looks at your tax return and they run a calculation that's to arrive at what's called modified adjusted gross income, or we'll call it MAGI for short. MAGI it's different from your from IRMAA in that it's for non-healthcare purposes. And so to determine whether you're subject to IRMAA, you have to locate your adjusted gross income on your tax return. So there's your adjusted gross income, which is essentially all your income before your standard deductions. It takes your any contributions you made to a 401k account or any kind of qualified plan will reduce your adjusted gross income. So this is essentially after you've made those contributions, before you take your standard or itemized deduction, then you arrive at your adjusted gross income. Then what modified adjusted gross income does is it adds back certain other sources of income to arrive at your MAGI. And there's only one main thing here. The other three are going to be kind of outliers. The first one, A, is that tax exempt interest that you've earned or accrued. So municipal bond interest will be added back to determine your MAGI. But then aside from that, you can see B, C, and D here. Interest from U.S. savings bonds. Used to pay for higher education. Income you earned while living abroad is excluded for gross income. Income from Puerto Rico, some of these other, states, so American Samoa, Guam. These are going to be outliers for most of us, right? So it's really going to be tax exempt interest that's added back, and then that's going to determine what your modified adjusted gross income is. And then once that's determined, so now you have your modified adjusted gross income, then you're essentially looking at these brackets here. So the 2023 IRMAA brackets are based on, again, 2021 income. So if you look at 2021 MAGI for single filers and 2021 MAGI for joint filers in the left column and the right column, you'll notice that those are the levels of income where where you'll start to see the surcharge increase. So again, for if you're single, if you're a single filer or a married filing separate taxpayer, and your MAGI was, so if you're single and it was greater than 97,000 in 2021, or a joint filer and your MAGI was greater than 194,000 in 2021, then you're going to be subject to Medicare surcharge. The amount you're going to pay is based on a sliding scale, right? And so you can see it here, right? And so the more income that you have for 2021, the higher that surcharge is going to be for Part B and Part D. And so again, if you're a single filer, you're going to be looking at that most left-hand column. If you are a joint filer, you're going to look at the column next to it, and then you can see the impact on the right and for Part B and Part D for your premium. So you can see that it's not a small amount, right? It's nothing to sneeze at. And so if you're being hit with this year, you know that you did something in 2021 where you must have had more income, right? Maybe you had, and income can come from lots of places, right? It could be earned income. Maybe rental income. Maybe you sold real estate, or you sold some stock in a taxable account. And so you realize a large amount of capital gains that'll push up your income. Maybe you did a Roth conversion and you did too much, or maybe you took too much out of an IRA account, right? A large distribution, that's all going to increase your income. Right. So if it's going up this year, then you'll know. And then so you want to be mindful now that you know this. Well, this year, whatever I do this year is going to impact me 2 years down the road. So 2025. Right. So we're always kind of looking ahead, when looking at financial planning strategies. So how are you going to be notified? That you're now subject to IRMAA. So if you owe IRMAA, what happens is the Social Security Administration will let you know by sending you a letter. And here's how that works. When you're first enrolled in Medicare, you'll pay standard Part B and Part D premiums. Then if your income is higher enough to trigger IRMAA, the Social Security Administration will send you a predetermination notice. And if you believe the information that the Social Security Administration sends you is inaccurate, you only have 10 days, right? You only have 10 days to contact them and dispute the notice. Otherwise, the Social Security Administration will send you an initial determination notice within a few weeks of sending the predetermination notice. And so, you have to respond to them fairly quickly as well, right? And to dispute your IRMAA surcharges. So strategies to avoid IRMAA. There's quite a bit of strategies, as you can see here. And so, the first one's going to be a charitable gifting, right? So, well, let me back up. So, lowering your modified adjusted gross income, like I just mentioned, that's going to help you reduce or avoid IRMAA in future years. So here are a few examples, right, of some different tax planning strategies that can help you kind of lower your taxable income. So the first one is you could do some charitable gifting, right? So charitable giving is donating to, you can donate to a donor advised fund. A donor advised fund is kind of creating your own charitable fund, and the money that you transfer that fund. So whether it's it's like securities or cash in that year you donate to the fund, can basically can be deductible depending on your tax situation. You can also make a qualified charitable distribution as well. And a qualified charitable distribution is essentially distribution from your IRA. Once you reach the age of 70 and a half, it has to be done through a special form, through your custodian or through your broker. And it's basically donating money directly from your IRA to a charity. And that can also lower your income as well. And you're basically making a lump sum charitable donation when you're doing that. Two, if you have earned income, you can reduce your modified adjusted gross income by making a tax deductible contribution to a traditional IRA or a 401k. So, basically what you're doing there is you're lowering your income, right? Because again, you're by donating, you're completely lowering your income because you're not reporting that to the IRS. So think about, let's say your salary is $100,000. You put $20,000 in your 401k. When you file your tax return, it looks like you only made $80,000. So by doing that, and then again, if you don't have a 401k, you can make a traditional IRA contribution. And if you're eligible, then that contribution can be deductible, and the amount that you can put in, it's a lot smaller than a 401k, and depending on whether you're over the age of 50 or not, but the amount $7,000 that you can put it into a traditional IRA. And then withdraw money from a tax-free source in retirement, like a Roth IRA, will help out instead of taking money out of say a regular IRA, which again is going to be income taxable. You can also consider doing Roth conversions in years when your income's lower, so you can benefit from more tax-free withdrawals in retirement. But really, essentially, the strategy to avoid IRMAA is anything that's going to lower your income. So again, if you're selling, if you're liquidating investments in a taxable account, that money is going to be counted as income for you. Again, taking money out of IRAs, 401ks. If one spouse is still working and they're not utilizing their 401k plan to push their income down, that's something that you can do. So there's going to be a lot of things that are going to be available for you. And so and don't be alarmed, by the way, if let's say this year you are subject to IRMAA. And it's because, let's say you sold real estate, right? 2 years ago, you sold a property. So in that year, you'd be subject, but it doesn't mean you stay there. Your premiums will come down. Again, if the next year your income wasn't that high. And so that's IRMAA in a nutshell. It's not that complicated, but it's just important to understand, right? You don't want to pay extra medical expenses, especially if you don't have to, especially if you can control your income, which there are a lot of ways to do that, as we kind of talked about here in retirement. So, working with a financial planner or other tax professionals who can help you identify strategies to help to reduce your modified adjusted gross income and avoid the IRMAA surcharge is recommended. To make sure that, again, you're not going to pay the extra surcharge if you don't have to. And if you want to read more about IRMAA, we created a recent blog post recently. Just visit satoriwealth.com /blog, and you can read all about it in more detail there. Until next time.